Let's move on to another module, which is inventory analytics. But before that, what I want to tell you is that cost of goods sold is the most important, right? We know that already. But companies in the same industry sometimes they have the same supplier base and production technology. So which means the cost of goods sold may be hard to change. So companies may want to work on their own sales, general, and administrative cost to get cost advantage, right? One example is the computer company, like computer industry in the US, right? They have the key suppliers, right? Intel and Windows from Microsoft. So they're competing not on technology, but on customer service and SG&A cost. And SG&A is the second largest cost, right? And so let's say, if you can squeeze SG&A, which is in red in this case, right, and make it smaller, think about what's going to change, right? You can make more profit, right, if you squeeze SG&A, or you can reduce your price, right, and make a higher profit at the same time, right? Like the Dell and Compaq example, right? And through better inventory management, Dell was able to achieve this. And here is the data. And we call this the $24 billion insight because Compaq sold itself after observing this data and made a lot of money, avoid the disaster. So, and let's say if you can say the same thing as Compaq was saying, right? So around year 2000, that's the time Compaq sold itself. Right? We can say that Compaq gross margin is about 22%, and Dell is about 21%. However, Dell was better at managing its inventory, right? With inventory days about 6 days, Compaq 25 days. And that translates to smaller operating costs over sales, right? Dell 10%, Compaq is about 14%. And so if you do the math, subtracting operating costs from gross margin, we find that Dell outperformed Compaq by about 1% in operating margin. Now, here's a question I ask a student, right, to see if they really understand, if they can really tell a story behind the data, right? Why is this 1% so critical? The Compaq gave up the competition and sold itself. Now, what I want to claim is this picture, if you really understand it, right, you will understand why Compaq sold itself, right, and really exit the market at the right time and made $24 billion. Now, if Compaq continue like this, they will lose pretty badly after this, right? The question is, through this data, can you see what Compaq were saying? So to understand why Compaq selling itself, why this 1% is so critical, right? We have to really understand what's behind these two numbers, the gross margin. Recall that they are selling a product almost identical to each other, but at a very different gross margin. Why? There are only two possibilities, right? The first is, right, Compaq get a better deal from the suppliers. And the second possibility is, right, Compaq is selling its product at a higher price. As we said before, they have the same supply base, same suppliers. So the deal they get from the suppliers are the same, most likely. So the difference of the gross margin can only be explained by their pricing. It turns out Compaq had about 10% higher selling price for their products than Dell. So here is the punchline, right? Even with a lower price, Dell made a higher margin. How can Compaq compete? If Compaq reduces price, Dell can follow, and Dell has more room to reduce the price. With the lower pricing, the market is shifting towards Dell constantly, right? And Compaq sees this is coming and really understand the meaning of these numbers and sold itself, right? While it's still worthy a lot of money. So that's a very smart move, but not everybody sees that, right? Because the company bought Compaq HP clearly didn't see this. So let's move on to inventory analytics, right? So in this module, the learning objective, right, is not really to tell students how to optimize inventories, right? It's not to teach them the models. It's actually is to do the things before solving the problem. That is to discover the problem, to define the problem, right? The learning objective, right, is to for students to find out for which countries and industries, right, is inventory important and relevant, right? Remember, this is to reduce the cost of goods sold, to better manage cost of goods sold, right? Inventory management can be very effective for some industries, but not for all, right? The second question is how may inventory drive a company's financial performance, right? Does it really matter, right? When we make improvement in inventories, does it really matter, right? We have to know this, right? And of course, how do I know if I have an inventory problem? We may not have an inventory problem because we may already at optimal or close to optimal, right? There's very little room for improvement. It's possible. How do we know? And of course, how to prioritize and manage different type of inventories. So this part is about inventory modeling. So after we go through all the first three questions, then we talk about inventory modeling, optimization, and control, and so on. And the case would be the Macy's, TJX, and Ross stores. And lecture time about 60 minutes. And the homework is for students to find inventory problems by themselves on the industries and companies of their interest. Now, student testimonials. So when students send the weekly module, especially many other things, and including inventory analytics and sourcing, stood out to me as highly relevant and practical. And inventory analytics was eye-opening. It made me realize how much impact inventory has on both financial performance and customer satisfaction. I found inventory analytics module, right, particularly useful as it provided practical insights into how inventory decisions impact overall supply chain performance. I found sourcing and inventory analytics to be most useful in my case because I deal with these aspects the most in the job I currently working at. Okay, now this is a long lecture. I won't cover everything, but here I want to share a few exciting moments. The first thing I want to share is, it turns out inventory problem is very persistent. So which means if an industry, let's say here for US, which is consumer discretionary, retailing, for example, right? If an industry used to have inventory problems, they're going to have inventory problems in the future, right? So look at this curve. It's consistent over time. They do not cross often, okay? So it turns out consumer discretionary, right, for the United States constantly has the highest inventory over total assets ratio, right? More than about 15%. Now it went down a little bit during the pandemic, but it went back, right, after the pandemic. And it's followed by consumer staples. So in these industries, you typically find a lot of inventory problems, right? Like retailing, like groceries, right? Like automobiles and so on, or fashion apparels and so on. In terms of real estate in the US, has the lowest inventory over total assets ratio. Like this is the median, industry median. Right, so you won't typically find the inventory problem in real estate industry in the US. For a different country, the things could look very different. Let's say in China, the real estate has the biggest inventory problem, right? Consistently has the highest inventory over total assets ratio, right? So 30% of the total assets of the company is in inventory. They are followed by consumer staples, which is same as US. And energy in China has the lowest inventory over total asset ratio. So energy for China and also for US have very little inventory problems. It's an interesting observation, right? So if an industry have inventory problem in the past, it tends to have inventory problems in the future. It's very consistent over time. So I want to share this. I think this is interesting. Now, the second thing I want to share is inventory for some industries actually have significant impact on the financials. Let's say use US retailing, S&P 500 companies as an example. We observed constant and strong correlation, right, between the inventory turnover, which is x-axis, and the sales general and administrative cost over total revenue. So which means faster inventory turns will lead to lower SG&A cost for retailing. Okay, and the R square is constantly above 50% for all these years. And look at this, and the slope looks the same. Okay, now let's come down to the last question, right? How do I know if I have an inventory problem? Right, it's easy. Actually, this question can be easily answered by data analytics. You just plot the inventory dates or inventory turnover on the same map. You will see that, right? For instance, right, for apparel retailing and department stores in the US, right, we find Macy's carry about 120 days of inventories. Right? While in the same business, the Ross stores and TJX carry only about 50 days of inventory. So Macy's likely have an inventory problem. So now let's look at how the inventory impact their profitability. So we have a revenue breakdown for the US retailing. The first thing we find out is, right, they have very different cost of goods sold. Right, the industry average is like 72% cost of goods sold, right, which is the same as CJX and the Ross stores. But if you look at Macy's, it's only about 60%. And retailing, what they do is to get the clothing from the suppliers and resell it, right? So the different cost of goods sold really means a different pricing, and they're also operating in the same market in the same country, right? So using the cost of goods sold, you can calculate their average pricing for an item of $100. Let's say they got from the suppliers. Macy's is going to sell it for $167. At Ross stores and TJX, about $143. So Macy's has much higher pricing. But with much higher pricing, we see that the net income is much smaller than the other two, than TJX and Ross store, right? That's because Macy's has such a high SG&A cost. See that, almost 35%. If you look at industry average, it's only about 16%. So Macy's spend a lot more money than the peers, than its competitors on SG&A. And if you look at the asset breakdown, we see Macy's carry a lot more inventory. The industry average is about 14% of the assets inventory. Macy's is 26%. Right? And recall that faster inventory turnover will reduce the SG&A cost. So one of the main reasons for Macy's such a high SG&A cost, it's inventory. It's the huge amount of inventory it's carrying. Right. So in summary, like put all these puzzle pieces together, we can see that TJX and Ross store, they have much lower inventory level, which leads to lower SG&A cost. So they can reduce their price and also make more profit in the same time. And Macy's is the other way around, right? They have higher inventories, much higher SG&A cost, and which leads to, so for which they have to charge higher price. Even with a higher price, they make less profit. And of course, they have slower growth because of the high pricing. Now, if you look at Macy's data by itself over years, we can say the same thing, right? So in the recent 5 years, from the year 2020 to 2024, right, we can observe a clear downward pattern or negative correlation between the inventory turnover and sales general administrative cost for Macy's, right? So Macy's data support the insight. Faster inventory turnover will reduce its cost of goods sold. Through the data analysis, right, you can provide convincing evidence, right, to help this company diagnose, right, the problems in the area of inventory management, of course, right, to really point to the impact of inventories on their financials and also identify problems for Macy's, for example.